What a day. What a day. Nvidia shocks the markets. We get some interesting machinations here around Fed policy expectations and a very interesting view on what comes next after this unexpectedly action-packed several days. This is Macro Money. I'm Ilya Spivak, head of global macro here at Tasty Live. And what we're going to do here is take a look first and foremost at how all of this fits into the narrative that we've been following here since that explosive speech from Fed Chair Powell on Friday, and how all of this is looking like it may play out next. Of course, a huge input into this conversation, the earnings that we just saw from chip-making giant Nvidia, but also an interesting aside here directly from that Nvidia report into a conversation developing around China. We'll update what we're looking at there and consider what it all might mean for where markets are heading next. So let's begin with just a brief reminder here of how we are coming into this week and what all of this seems to imply. So this was how the markets reacted on Friday to Fed Chair Powell. It was unmistakably optimistic around the idea that indeed rate cuts are coming, and the Fed chair did not use this speech to disabuse the markets of that notion. Stocks go up, yields come down, gold goes up, the dollar weakens against its major counterparts. We can see that here with the yen and euro, the big ones, and Bitcoin, of course, reveling as it does in a risk-on mood with an amplified sort of performance. So pretty clear cut. The market hears Powell. We've talked about it on the show this week, how the language there seemed like the stage was indeed getting clear for the September rate cut. And then we look at how we performed this week. And this is before the Nvidia news after the close, which we'll get to momentarily. Stocks essentially going nowhere. Rates a little bit tilted on the downside at the front end, down 2.24%. That's especially something that hits today after we get a pair of bond auctions, in particular the 5-year sale today, but also results from a shorter term auction. We had some more immediate paper on offer today, the 2-year FRN auction, as well as the 17-week bill sale, and meaningful declines on rates there. We have a significant low here on the 17-month bill rate, a significant low on the 5-year rate. So a little bit more confirmation from the markets, not that we needed it, not that we didn't know that this was coming, but nevertheless, a little bit more confirmation that we have a rate cut in the offing here. So markets take some additional comfort, it would seem, at least on the rates side of things, from that little tidbit, and we end up with a little bit more of an outsized move lower on the 2-year. But otherwise, things look very quiet indeed. And so we come into this conversation after that Powell speech with this sense that perhaps the markets did not find follow-through. We have the U.S. dollar notably stronger recovering almost all of its losses against the major currencies and erasing the move against the euro almost in its entirety. Bitcoin sharply lower. Gold's still holding up, ostensibly around what we're seeing here, but the situation much more muted at the long end of the curve. And it's not for lack of for lack of conviction in what Powell said. As a matter of fact, we can see here rate cut expectations have been holding very firm here, now at about 87% chance for a cut, but not too removed from yesterday, and in fact, not too removed from a week earlier, which you can see is marked as August the 20th. So this is actually before Powell's speech, where we already see the probabilities were relatively strong. In fact, there was, we can see a month ago, a little bit of a wider spread here, a little bit of a chance for a 50 basis point cut, about a 60 odd percent chance for this cut. So already there, but the spread a little bit more dispersed, about a 35% chance that we hold. Well, that ambiguity is clearly gone and it's not going anywhere. Moreover, we can see that the outlook for the coming year has anchored around the Fed's own forecast of 50 basis points for this year, give or take some rounding error. A couple basis points here, a couple basis points there. That's, of course, the same as the forecast that the Fed has been projecting since December, well before the new administration took place in Washington and threw a wrench in the works with its tariff efforts. So the markets are anchored around what the Fed said then. The Fed has reiterated that forecast again in March and again in June. And so here there seems to be stability. Nobody appears to be relatively surprised by what's coming. The situation for next year is growing increasingly dovish and continue to do so today. We're out to 82 basis points on the menu for next year. That, of course, is a very significant sort of escalation in a story that is very clearly insinuating that the markets are still looking at all kinds of room for the Fed to keep cutting. That obviously clashes significantly from what the Fed was itself forecasting back in June. In that summary of economic projections, the Fed had a meager 25 basis points on the menu for next year. And so this is perhaps why the markets are somewhat lackluster in their follow-through for what Powell said. It looks like what he did was remove uncertainty around some sort of a rug pull kind of a situation where the Fed might have said, you know what, we're not as ready to cut rates as you all hope. And so it seems like the markets had about a day's worth of relief, and we're not able to find anything else in that speech. And so perhaps the catalyst for whatever was going to be the dovish Fed narrative is, at least for the time being, until we see some more economic data. And of course, we'll talk about the PCE report that's coming up later this week on tomorrow's show. But at least for the time being, it looks like that story might be out of juice. And so with that in mind, we have a kind of stayed reaction. And then, of course, there's this. This is the reaction from Nvidia shares after hours, after the company's fiscal second quarter results. Revenue comes out 46.74 billion. That's a slight beat over 46.02 billion expected. Adjusted EPS of $1.05 a share. The expectation was $1.01. So a little bit better than expected, but not a whole lot. The magnitude of the surprise, in fact, relatively modest here compared with some of the more recent numbers that we've seen. For example, one quarter ago, we were looking at a beat of almost a 10% margin, about 9.8. This ends up being a beat of just 3.9, let's call it give or take 4%. So within the lower end of recent outcomes. In fact, this is the weakest beat on EPS in recent memory. So certainly a beat, but not exactly rosy results. Nvidia also approves an additional 60 billion share buyback. And needless to say, this, of course, is not just relevant to the company itself, as we've talked about extensively on the show yesterday. This is the largest of the Magnificent Seven, which already make up a huge share of market cap. And we can see here, in terms of NVIDIA's weight, it accounts for 8% of the overall S&P 500. So it is an absolute behemoth. And this will not only be relevant, this disappointment, for the overall sort of story around NVIDIA itself, for the story around AI and the optimism there, and certainly then becomes a kind of macro indicator for overall market sentiment. At a time when the market had its positive Powell catalyst and then decided the story was over, again, because there was so much more easing that the markets were already baking in, that the Fed would have to go a long way still to meet these lofty expectations. Now, we spoke going into this announcement about how the other 6 of the Magnificent Seven fared in their earnings reports this cycle. And we can see here, we have roundly beaten expectations on all but the EPS number for Tesla, which came in right on the screws. So we have a run of positive results here, and of course, most impressively with Meta, where we have a dramatic beat on EPS. And indeed, the stock had a huge, nearly 12% day that day. But as we pointed out, we don't really have a responsive market, even in the face of these results. The markets yawn at Google and Tesla. We get a gap higher for Meta and Microsoft around those Meta earnings in particular, but that gap is immediately faded, and markets actually come in after the initial after-hours pop. Then Amazon and Apple come in, and again, it's not as though those results are by any stretch awful. Round of beats on both EPS and revenue, but the markets ultimately swoon. And only later do you get this build into record highs. This is the Mag 7 ETF from Roundhill, just to give us a sense of what's happening in the isolated space. And although we can see here that since those earnings run their course, that's this right here, and sort of looking at the uptick thereafter, this appears less to do with whatever was happening with those earnings, which happened back here from the 23rd to the 31st of July, and more with this downshift in Fed expectations by year end. This is Fed funds futures for December of this year, the implied rate. So you can see that there is a big revision lower to a more dovish setting, and that's ultimately where the markets start to grind higher and reach a peak on that CPI report on the 12th of this month, after which the markets got soggy across the board going into Powell. And of course, this then is Powell. And since then, we've gone again, not very far at all. We discussed yesterday already this idea that the markets were punishing bad news in an outsized way in this environment, as opposed to rewarding good news. Now, this is not entirely abnormal. Of course, the market expects CEOs to be guiding when they issue their forecasts on financial performance, to be guiding such that they can underpromise and overdeliver. And so some degree of upside beat is expected relative to forecast. And so we can see that the 5-year average here already has positive results being rewarded with about a 1% 2-day move, a negative result punished by more than double that with an average 2.4% move. But this particular reporting season, the disparity is all the more glaring. Only a 0.4% up move on positive surprises and a huge 5.5% number for negative surprises. So the markets seem already to be more sensitive to bad news than good news. And that seems to suggest that maybe we are looking not only at exhaustion in the Fed story, but perhaps exhaustion in the stocks as driven by tech, as driven by AI optimism, and as driven by the idea that basically all of this can get front loaded into a huge sort of tech powered outperformance, everything else notwithstanding. Perhaps that story is running into a situation where it also is beginning to run on fumes. And it is with this that we get to the real meat of what seemed so disappointing in these Nvidia results. It wasn't so much that the numbers were soggy. As we say, they did in fact beat relative to expectations, albeit by much smaller margins than recent history. But the big question was their forecast on revenue. And we can see here that there was an unusually large gap this time. This is the forecast for fiscal third quarter revenue right here. And we can see here a wide disparity in expectations. And much of this disparity has to do with whether Nvidia will be able to sell chips to China. The Biden administration blocked them from doing so. The Trump administration started with blocking them from doing so, then recently reversed that and said, well, if you're going to sell chips to China, in particular the H2O chips that were slated for it, well, then you have to give us a 15% cut of the sales. And so there was a lot of question as to whether these forecasts would include sales to China in the estimates, suggesting that the company expects that market to become open. And when we look at the estimates for third quarter revenue that Nvidia released today, it is somewhat soggy, 54 billion plus or minus 2% leeway against expectations of 53.46 billion. So definitely on the low end of expectations here. Certainly doesn't help that data center revenue came in a little bit light for the second quarter, 41.1 billion versus 41.3. But it's really the forecasting that stands out. Nvidia saying it did not include sales to China, of which there were none, into these second quarter results. And when we look at this revenue estimate coming in on the low end, the presumption seems to be, well, there won't be sales to China, or at least there's not going to be a meaningful uplift from sales to China in fiscal third quarter, which sets us up for a look at China, where in fact over the weekend here we're going to get updated Purchasing Manager Index numbers suggesting that we might get a little bit of a wiggle higher. These are going to be the official figures from CFLP, the China Federation for Logistics and Purchasing, alongside the National Bureau of Statistics. So The expectation is that China's economy is going to stick relatively close to neutral, as ever in the logic of PMIs. 50 is the center line where there is neither growth nor contraction. Above 50 is growth. Below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. Manufacturing expected to remain in contraction mode. Services expected to hover near neutral, as is the composite index, but a little bit better, a little bit more into a positive direction here than the prior month. Of course, this is a critical story about demand from the world's top three sources of GDP growth. Between the US and the Eurozone and China, we have 58% of global GDP. And as we can see here, Europe has been quietly improving here a little bit. The US has remained relatively strong. Looking at the S&P global version of the numbers, China has been soggy. And if we look at the problem here, of course, we've talked about it extensively, it is that there is virtually no demand to speak of. With real GDP running above nominal GDP, we have now 9 consecutive quarters of de facto economy-wide deflation, which basically suggests the entire economy is in the bargain bin. There's not enough demand to clear available supply, so prices are sinking. We saw this in spades in the latest inflation numbers. CPI pegged to 0, just a hair above. Wholesale inflation still deeply in negative territory. But the markets have seemingly sniffed out perhaps something more positive. We see that we have the credit impulse index for China, the share of new loans in GDP, starting to finally see a little bit of positive growth. This is as of July. We don't have August numbers yet, but starting to finally see a little bit of positive growth. And the markets are perhaps even getting a little bit of optimism there. We can see that there's an uptick in northbound capital flows through the Stock Connect, which connects markets in Hong Kong with those on the mainland. Northbound flows would be flows from Hong Kong and into mainland bourses. In other words, more demand both from Hong Kong and, of course, from foreign investors as an extension, because they're using Hong Kong as a hub through the Stock Connect to get exposure to mainland shares. The situation in Hong Kong itself still relatively vibrant here. We saw this pickup in flows last year and now again, but whereas last year they came with weakness in flows domestic on the mainland, and it seemed like it was more like money exiting the mainland than going southbound and out through Hong Kong. This is a different story now. So perhaps the markets are starting to get a little bit more optimistic about a China turn, and that, of course, makes this Nvidia report a little bit jarring and makes the PMI numbers that much more interesting, because Chinese economic data has actually tended to weaken relative to forecasts recently. Looking at this data from Citigroup, and we find, in fact, it is now below 0 on this measure, which suggests Chinese data now tends to disappoint relative to forecasts, which, of course, makes the current situation that much more interesting, because if the Fed story is running out of speculative juice, and if these Nvidia earnings are telling us that, but for China, revenues are on the low end for the AI space, and though there is clearance to sell to China, the demand may not be there because the economy is weaker than meets the eye, when there's plenty of optimism to unwind and risk appetite finds itself without a new batch of fuel to burn. That sets up as bad news, perhaps, for the S&P, for NASDAQ, and for U.S. stocks in general, and perhaps paints a more positive story for the U.S. dollar, which has tellingly benefited from risk aversion and shown itself impervious to building Fed rate cut expectations for next year, at least for now. And that is Macro Money for today. As ever, we are here right after overtime, a show that I co-host with Dylan Ragan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. Writing for the news and insights portion of tastylive.com, commenting at Ilya Spivak on the platform formerly known as Twitter and on Blue Sky. If you're watching on YouTube, like and subscribe. Macro Money's back tomorrow. Happy trading.